and welcome to Project 3 Portfolio 1. This is where we actually start doing some good work, right? So, you've learned just enough that you are like, oh, yeah, I could totally do this, right? And so, what we want to do now is rather than just learning, let's start applying some of what we've learned right now. And what we're going to start doing is building hypothetical portfolios for different types of people or people that meet different profiles, right? And so in this particular case, portfolio one, we've got a 21-year-old single person, right? So let's assume that, maybe it's somebody like you or somebody like a lot of you. You're making $28,000 a year, which is minimum wage. You're able to put together $1,000 and you got about $100 a month that you can invest going forward. Assume that this young person wants to buy a house in 10 or 15 years. That's their objective. Do not fret about where they buy the house. That's not really what this is all about. This scenario is really about the fact that we've got somebody that meets a particular profile and they've got an objective. And then how we interact with the document going forward is really what's important. So let's go in and say, let's start by filling it out. So we know we got $1,000 and we've got $100 a month. So first thing we need to do is we've got to address the what to invest now, right? So $1,000 and I've got $100 a month. You're gonna have to change this on every time that you submit. Then what we need to do is, and this is brand new. I'm doing this for the very first time this semester because there's a lot of concern that the stock market is getting a little uh, uh, out of hand, right? There's a little bit too much exuberance. Some of the terms that they're using is they're saying, I think the market's maybe getting a little ahead of its skis. And if you're a skier, you get ahead of your skis, that's when you crash, right? And so what I am going to have you doing now is starting to go grab where is the S&P. The S&P 500 is it represents the 500 biggest companies in the U.S. And when we refer to the market, we're referring to the S&P 500. And so we want the PE ratio, which is the price earnings ratio for the S&P 500. And if you go to, we've already talked a little bit about PE ratio, but there's a bunch of links here that'll give you the basics. What is a PE ratio, right? But it's essentially a measure of earnings. And so normally the higher the measure, the maybe the more risk, right? But you're normally able to connect that PE ratio with the company's growth rate, or with early stage companies that are really growing super fast may have really high PE ratios, and but that's because they're relatively small, and it may take them a little while to mature. But the historic S&P 500, historically, it's been somewhere between 15 and 20. So your very first job on every portfolio we build is going to go to be to update this. By the way, the S&P 500, their PE ratio changes on a regular basis. So you're going to have to update this on every portfolio. Don't just save it and give it to me because I'm checking them too, right? And I want to make sure we're using real data. And I'll tell you why this is important in a minute. But let's get to the how do you get that information? So probably one of the easiest places to get TTM, which is the trailing 12 months. That's what TTM stands for. So we want to go to maybe something like Yahoo Finance and put in SPX. And it's going to give you the Standard & Poor's, the S&P 500 index. And it'll pull up it'll pull it up. And then what we could do is scroll down a bit to where they've got some, let's see, where's the analysis? Oh, they're not going to have the analysis because this isn't, when you have a stock, it's easier. So let's go to ChatGPT. And what we could say is, what is the current uh, uh, PE ratio, let's put in TTM, PE ratio for the S&P 500. So the trailing 12 months, what is it, right? It's going to give us it's like, as of July 20th, it was 28.9. So they vary a little bit because, um, it's just based on time. So let's just go with, let's take a blending of these. Let's go with 28, right? So the current TTM is 28. Now we want the forward 12, right? So let's just copy this. Thanks. What's the forward PE ratio forward 12 for the S and P 500? So look at this. It looks like it's varying somewhere between 22 and maybe 24. So let's go with 23, right? So we've got our PE ratios. So right off the bat, if we look at historically where PE ratios have been, we've already got PE ratios that are high. And so that's just sort of one of the things we just sort of want to be mindful of. We're dealing with a stock market it is pretty high relative to what we expect earnings to be. So now let's go through and start building our portfolios, right? And let's assume that we're going to draw some of the names that we did in what do you call it? Project One. So let's go back here and let's say we want to buy Costco. So let's assume that Costco would be a good investment for somebody that is 22, 21 years old. They got $1,000, right? So here's what we could do: is we go into Costco, we say Costco, we're going to type it in. We want Costco, and then put the stock symbol in parentheses. Don't just put the stock symbol. Make sure I know what company this is. And so what we want to do is we want the PE ratio. I want the trailing 12. We want the forward 12. So in this one, we can scroll down a little bit and it will tell us, it'll give us valuation measures. Okay, so we got the trailing PE is 52. Oof. And and the forward is 48. Okay. So already we've got Costco that is trading at a much higher, richer, higher valuation than the S&P 500, right? So let's go back to ChatGPT. What is the historic PE ratio for Costco? So it's not going to give you exactly because it's going to be like, well, it varies time to time, blah blah blah. But you're going to have some data here, right? The trailing PE, most recent trailing is 50 to 52. Okay, we've got that over here. Now, if we take a look over the longer term, going back many years, it's varied a lot. But if we just go back like 10 years, right? Their valuation was 24 to 26. Now, in 20, it went nuts. 23, it was still really, really high. Why? Why? Why do you think that was the case? Think for just a second, right? Yeah, COVID-19. And it was more than just toilet paper. Everybody was going nuts because you could go to Costco. And I remember, standing in a line that was, at least 100 yards, man. It was just ridiculous, wrapped around the building. And yet everybody's like, doing their safe distance, 6 feet apart, and what a mess. But their valuation went nuts. And so if we take a look at 10 years, their historic is 38 to 39. And so let's put in 38. What does this mean? What does this mean, right? Well, this means, that right now Costco's PE ratio is higher than it's been historically. Yeah, maybe Costco's, got a growth spurt underway. It probably does. We can also ask ChatGPT that. Why is their PE ratio so much higher than average? Why is the current PE ratio? Thankfully, it knows that I can't spell. Yeah, I mean, this will tell you, right? Costco isn't valued like a normal retailer anymore. Investors see it as extremely predictable, resistant, resilient, inflation resilient, membership driven revenue. Absolutely, right? The renewal rates are off the charts. So investors are giving it a higher PE ratio because they're viewing it differently, right? And so, and they're also, by the way, they're also, pricing it at near zero risk. So let's assume that we had, if they miss a quarter, that stock is going to get pummeled, possibly, right? But this is what we want to learn and know as we're building portfolios. So now we've got a little bit of information here. Okay, got it. Maybe what I want to do is I want to put 25% of this guy's portfolio into this. And now, let's see, we need to come up with a projected annual growth rate, right? So we can ask ChatGPT, what's the stock's average growth rate over the past, say, 15 years, right? All right, wants me to give it some feedback. All right, let's see. 15-year, 22%. 15 years ago, 20 times. 20, so we've got a little bit of a range here, right? It's averaged between, hold on, the music's getting a little loud. Alexa, off. Um, and so, we could probably go with, 20% is what we expect that growth rate to be. And does it pay a dividend? Let's ask, does cost pay a dividend? Let's see. Yes, it does. It pays $1.30 a share. The current yield is 0.5%. So we just got to put in 0.5. Oh, no, 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 no. 0.0005. Yeah, that's right. So that is the first company that we've got in here. So what you need to do is pick four companies. So maybe we want to, this person's relatively young. So maybe we do want to look at somebody like NVIDIA, right? So NVDA. And so we want the same thing, right? What's the current PE ratio? So let's go to, let's type in NVDA. And we want to scroll down so we can go get that historic information. So trailing PE is 45. Trailing is 45. Forward PE ratio is 24. Wow, got it. Now we need to find out what's historically. So let's go ask ChatGPT. Thanks. And this is what you're going to do. And this is part of you sort of going through and going, I got it, right? So let's see, the lowest rating was 20 to 35. The typical 10-year range is 50 to 53. So let's go in and let's go with that, right? The average 10-year, 50 to 53. So let's say that historically it's been at 50. So if they're currently trading at, did I say they're trading at 24? Or did I just type that wrong? Oh no, that's forward PE is 24. So historically, here's the deal, right? Nvidia is the most expensive company in the world, the biggest company in the world by market cap. But if historically they've traded at 50 times and their forward numbers are 24, that indicates the stock might still be cheap, right? But here's the deal. We got to do a little bit more due diligence than that, right? And why is NVIDIA being valued as it is, right? Don't say so high or whatever. Keep it, sort of vague. So it's got to go in and think a little bit. And it will do a good job, right? But don't go in and be like, why is the stock so high? Why is the PE ratio so low? Use it. Allow and force ChatGPT to think a little bit, right? So this is why, take a look. It's no longer valued as just a semiconductor. Earnings growth has been extraordinary. NVIDIA's real advantage is its software system, which is ridiculous. AI, these are the reasons why it is so valuable. So, you talk about, hey, this is a young person. Maybe we want to put 50% of the stock in there. And then now let's ask, does NVDA pay a dividend? Yes, it does. It's a teeny tiny dividend, right? So it's going to be zero. It's going to be 0.0002. Yeah, very. Oh no, no, we want the projected return first. Hold on, let's go put that over here. 0.0002. Okay, and so we want a projected growth rate. Let's see what it says. Sticks projected. Thank goodness it knows that I can't spell. Look at this thing, man. Let's grow 50 to 60. This is just ridiculous. 27, 60%. Longer term, 25 to 30 over the medium term, a few years, 27 to 20. And here's the deal. It's like in baseball, where I'm a big baseball guy. Every time you get up to bat, you don't want to swing for the fence. And the reason is that that's how you strike out. And base hits win baseball games. Home runs are sexy. Base hits win baseball games. So, you could go in and put 50, 60%, or you could be a little bit more conservative, 20 to 30%. So let's assume that maybe we're talking about maybe a 30% growth rate. Don't forget, we're talking about somebody that's still relatively young, right? So we've got 75% of our portfolio allocated. And so now we need to figure out the other 25%. Once again, this is a younger person, so maybe you want to do something like Microsoft or something like that. I'm not a big fan of having too much technology, but we've got retail, or maybe look at an airline stock. How about Delta Airlines? This person, they like to travel, so let's take a look at Delta. And let's see, let's scroll down to the data. Dun, dun, dun. Trailing PE is 9, forward PE is 9. Look at that, the trailing. So we want Delta Airlines. And I think it's DAL. And it's 9 and 9.4. Pretty conservative company here. What's its historically? And let's let ChatGPT do a little bit of work for us, right? So look at this. It's traded 9 to 12, 9 to 20, 9 to 10, 8 to 9.5. Look at it's trading at about what it's going to do. Look at this. It's had big boom month periods, but maybe you're optimistic and you're like, yeah, I think this thing is, historic is been about where it is now, 9. And but we're going to put 25% of it. Now we need a growth rate. Got it. So what is the projected growth rate? Dun, dun, dun. Let's see. Guided 20%. Aggregators annual growth rate 3.5 to 4%, which seems more realistic. Near term 20% revenue growth 5 to 7. And you're gonna have to read this, right? You're gonna have to read this and then come back with the determination, but I'd say maybe 10%. And does it pay a dividend? You're gonna have to make the determination. I'm not gonna tell you what to put in the numbers. Does it pay a dividend? It does. 1%, right? So now we've got our portfolio built. And you only change the stuff in blue, right? If it's and so now it'll do the rest of it. So what this tells us is that this person will end up with about 14,000, almost $15,000 at the end of 5 years. The next step for you will be to then, because we were talking about 10 to 15 years, you'll click this next tab at the bottom, right? And now the carryover has carried over. So it's there. Now, what is the monthly this person has? $100. All you got to do is fill in the 100. And then you got to create a new portfolio. Now, we're talking about 10 years. At this point, it'll be 26. Maybe we can, roll this one over, right? We want to, he's going to be 26, 31 years. He's going to be relatively young. And so maybe we can roll this one over and without too much trouble. And then let's go grab those growth rates, 20, 30, 10. You fill it in, right? Go grab the dividend rates, etc. And then now we get to the end of 10 years, and this person's now at $44,000, but we need a 15-year portfolio. So now we got 44,000. They've still got $100 a month that they can invest. But now we're getting near the end, right? So they said 10 to 15 years. So now we've got that period in time in front of us. So now we're getting to the point where this dude might need the money. So now we need to shift our thinking a little bit and maybe be thinking about growth, but we probably should also be thinking about preservation. The reality is if the markets go south, they tend to go south for extended periods of time. I was just reading an article talking about how amazing the Nasdaq was doing, but when the last time the Nasdaq, during when the bubble burst, the dot-com bubble burst, it took more than a decade for the Nasdaq to recover. And so what we don't want that to happen to this person. So now we need to be thinking a little bit more defensively. So maybe we do want Costco, right? Because Costco is still, a pretty solid company. And I'm okay with putting a little bit of Nvidia in here. But maybe you are going to go at 25% of the allocation for Costco because it's a good company. And Nvidia, maybe now you're just going to go with um, let's get the stock symbol in there. And maybe now we're just going to go 10%, right? And maybe you're going to keep Delta and Delta's a little bit more, maybe we're going to go with 20% in Delta. And, now we're going to maybe look at other investments that aren't as aggressive. Maybe we're going to look at um, other stuff. But here's what we could do is we could go to ChatGPT and we could say, I have a hypothetical HYPO. They're 31 now. That has call it $45,000, an additional $100 a month, and they want to buy a house in 5 years. What would be a good portfolio? And the reason I don't mind you doing this is that the hard part isn't finding the portfolios. Really, the hard part is you picking out like what should they do, but also the reading what he's telling us and saying, I'm assuming ChatGPT is a guy. And this is what sensible and conservative. You want it short-term bonds, intermediate bonds, US equities, international REITs, which are real estate investment trusts. Simple, blah, blah, blah. It's giving you what you could buy, right? So a government bond would be bill, which would be the stock symbol. And BND, a total bond fund, equities, you could buy the whole stock market, the S&P 500. These are all what are called ETFs. And this is a good idea, right? What I would not do, look at this, 100% stocks, crypto, long duration bonds, aggressive growth portfolios, which is why I was originally thinking maybe we just really pull back on Nvidia. But I'm going to allow you to do the research. The key is that when we've got a 5-year horizon, we should be thinking more about how do we protect that $45,000 more than how do we double it, right? It's no longer a, hey, now's the time for us to grow. Now it's sort of like we need to take a step back and maybe be thinking a little bit more defensively and protecting our portfolio versus potential downside. So maybe that means, maybe it's only going to grow by 10 or 15 grand over the next 5 years. Who cares? The reality is that the person is then going to be 35, 36. Maybe they've partnered up and now it's time for them to go buy a house. And, they're going to go look in Tracy and maybe they got 10, 15% to put down on a house. Or they're going to move to Fresno. Now they got 20% to put down on a house. So um, we need to make sure that as we consider the amount of time somebody has, that we adjust the portfolio. The other is that when we start looking at some of the other projects here, we've got people that are going to be older. Somebody that's 55, they want to retire in 10 years. Are we going to be loading this thing up with NVIDIA? Probably not. Maybe a little bit, or maybe it's going to be more bonds. But this is where as the semester progresses and as we learn more about different vehicles and instruments, that we're going to be applying them to these different portfolios. Um, this is a lot of work. Each of these portfolios are, but the reality is building an investment portfolio is a lot of work. The good news is that we have ChatGPT to sort of back us up a little bit. And if anything, it will test some of our theories. So for those of you that are like, buy all NVIDIA, go all in. I tell you what, you could ask ChatGPT, what's the risk of somebody that's 31 that wants to buy a house in 5 years? What's the potential risk of them buying 100% of NVIDIA? And it'll tell you, there's a pretty good chance you're going to lose a lot of that money. And why would I say that? Because if we look at NVIDIA, let's just pull this up just for fun. This wasn't for the lecture, but what the heck? Dun, dun, dun. Come on. Let's look at this stock chart, right? So that's today. Let's open this chart up a little bit. Today it's doing great. It's up $3. But let's go back, take a look at the last 6 months. What's the interval? No, no, no. Give me. I need to go back. If we look at the last 6 months, I mean, look at these things, right? I mean, if you needed to, okay, I'm going to go buy my house now. Uh, um, you know, let's go take a look at a year. It's even a little bit scarier, right? While it's gone up, it's great. If I've got all of this time, but you know what? If I need to buy the house here, now I'm selling the stock for $92. I'm not selling it for 187. And that tends to be what happens, right? It's like I need the money, but I need it at the worst possible time. That's just the way life works, right? And so that's why you wouldn't want to buy all Nvidia because you may find your dream house, and you were looking for the house, when Nvidia stock was at 140 bucks, and now you need to put the down payment. You're selling the stock and you're selling it at 86. What a disaster, right? You've got almost half as much money as you did. And so, which is why we don't go all in. So watch some of the videos that are in here because, there is some conversation about modern portfolio theory. The whole idea behind modern portfolio theory And there's a whole bunch of math behind it. I ignore the math because I don't like math. But the whole idea is to diversify. You don't put all your eggs in one basket. And that's one of the ways that you're able to mitigate risk is by having a fairly diverse portfolio. So this is a lot of information. The key is take your time when you're working on these portfolios. Don't rush. There really isn't a need to rush. Learn about the PE ratios and then really sort of take it to heart and say, wow, Costco historically is trading at a pretty high multiple right now. I mean, it's trading its forward uh, 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 PE ratio is 10 points higher than it was historically. That tells us that Costco is expensive. But we go do our little research. Why is that the case? Why is it so expensive? This is where using ChatGPT can be really, really helpful. And this is where you taking that extra step to be curious and ask the why question will really sort of unlock the value of this class. I mean, I can show you some of the technical stuff, and this is how you go find that information. But at the end of the day, the more curious you are, the more you're going to get out of this class. And then at the end of the day, the more you're going to be able to apply to you building your own personal portfolios and beginning to accumulate wealth. So long video, because I've made a lot of changes to this, taking into account what's going on in the market. But also, I need us to begin thinking about how do we build portfolios in the most mindful way possible. If you guys have questions, you know how to find me. Peace.